Good afternoon and welcome to day 12 for managerial accounting for the fall 2022 semester. As we look at our Cengage content here in Brightspace, you can see that we have a couple items due today. So since we finished chapter 19 on Tuesday, the chapter 19 problem should be submitted by the end of the day today. And because we are starting chapter 20 today, the chapter 20 pre-quiz should also be submitted. As you know, 60% or higher gets you full credit, and anything less than 60% is no credit. So please make sure you turn those in with the appropriate score. Also looking ahead, next Thursday is October 6th, and we have the second step for the annual report project due at that time. So I want to talk about that for a minute. So let's go to that, the annual report project. So for the annual report project, there are 3 steps, each of which has its own points towards your final grade. So the full project is worth 100 points, but the first 5 points were for having a company approved. That's step 1. And all of those companies have either been approved, or I've sent you a note telling you what you need to do, or I've assigned a company to you if you hadn't chosen one in a timely fashion. Step 2 then is what's due on October 6th. And so I just want to clarify what I'm expecting here. The small print down here at the bottom really tells you what I want you to do. This part, or the directions, are what came from the original source for this project. So what you need is 3 sources. One of your sources is going to be the company's website. So only one of the 3 can be your company itself, but that definitely must be one of your sources. You then need, for this step in the project, you need to find 2 more sources for the project. And so obviously then those sources need to be something other than the company itself. So you're looking for maybe newspaper, magazine, journal articles related to your company and or the industry in which it operates. What I would recommend you do to help you find those sources, if you don't already have them, is go back to the instructions for the project, read those instructions, see what kind of information do I need to do this project, and then go find a source for that information. What you need to submit is very simple. I don't need a lot of information. I'm not asking for any kind of a rough draft of your project. This is strictly submitting your sources. So the sources, because I'm not teaching you how to do APA citation or MLA citation or any other kind of citation. Really, all you need to do is give me the link to the source that your source says. So you should have in the document that you submit, you should have 3 different links. 1 is going to be the company, and 2 are going to be outside sources, not the company itself. And then for each one of those links, just give me a couple of sentences, a sentence or 2 about what information you're finding at that source that's going to help you to write your paper, to write your report. So very simple, 3 links. Each one should have a couple sentences saying, here's what information is found at that link. As you then start working on your project, and for some of you, I hope, maybe all of you, but not unrealistic. For some of you, I hope, because you're going to get started with finding your sources, you'll also start writing the project, because there's nothing else we are going to do in this class that's going to be necessary for you to learn before you can do the project. So I hope that people will go ahead and start on the project now, since you have to be looking at it anyway to do the sources. As you're writing the project, if you find you need additional sources beyond these 3 that you have to submit for next week, that's fine. You're welcome to add more sources. If you find one that's better than one that you submitted, that's fine too. The whole point of the step 2 part of this project is to make sure that you can find the information you need, because I've been doing this project in class for years and years. And before I added in this step 2, you can imagine what happened. I would have people emailing me like the night before the project was due saying, hey, I can't find any information about my company. And my answer is usually, you picked the company. So why did you pick the company when you can't find any information? Not quite that crass about it, but the whole point, the whole reason I introduced this step a month before the project is due is to kind of force your hand to start looking for your sources if you haven't already, and to make sure that you can find them. Make sure you can find what you need. So 3 sources, 3 links. One's going to be the company, couple sentences about the type of information that you're finding there that's going to help you to complete the project based on what's required for the project. Questions, anybody about that? So that should be submitted right in this Dropbox right here in the annual report area, step 2. Okay, so as we continue on, then one other administrative kind of, 2 more administrative kind of notes. First, we've had an unfortunate health circumstance for one of the professors in Olean. And for that reason, my schedule's changing a little bit. It's not going to affect this class. It's not going to affect my Tuesday, Thursday schedule at all, but it does affect my office hours on Wednesday. So since the beginning of the semester, I've had office hours on Wednesday, and you guys were welcome and encouraged to see me during those office hours on Zoom, even though I'm not on the Jamestown campus. I am now going to, at least temporarily, starting the week of October 10th through Thanksgiving is the hope, but it may be for the rest of the semester, depending on how things go. So I'm going to be covering a class that meets on Monday, Wednesday in Olean. And so that means that my office hours have to change because the class conflicts with my office hours. So my new office hours starting October 12th will be Monday, Wednesday from 10 to 10:45. So it shortened my Wednesdays, but added some on Mondays. The total is still the same. And as is always the case, I'm more than happy to meet with you outside of those office hours anyway. But those are the hours that are in Starfish so that you can sign up. If those hours don't work, you always have been welcome to send me an email and ask for a different time anyway. So no change to Tuesday, Thursday, but there is a change to Monday, Wednesday, starting October 12th. And if you are so inclined, I would encourage you to say a prayer for that individual, the faculty member from Olean, because it's definitely a health challenge. And I'm not going to share any personal information. That's not mine to share, but say a prayer if you're inclined. He can use them, and his family. So the other thing I wanted to talk about, any questions though about the annual report project? I assume you don't have any questions about my office hours changing, but. Okay, so the last thing I wanted to talk about before we actually start talking about counting today is 6-week grades. So most, but not all of you have been at JCC before this semester, but I know we have at least a couple people who this is your first semester at JCC. So JCC does what we call 6-week grades, what other schools might call midterm grades. Occasionally you hear people here call them that, but it's not the middle of the semester. So I prefer the proper term, which is 6-week grades. Today is for this class, the end of week 6. Monday is the end of week 6 for all classes. And it's only on a Monday because we had Labor Day off, if you recall. So Monday afternoon, all of us teaching faculty are required by Monday afternoon at 3 p.m. to submit 6-week grades. For me, that means this is the grade based on the weights in the syllabus for all the different categories, this is the grade that you would receive in this class if the class ended today. So, because we didn't have any big assignments still outstanding for this class. I've actually already done your 6-week grades after class on Tuesday. And those grades include everything through exam 1. And if you had submitted anything beyond that, they would be included. If there are items that you haven't submitted, then those items would be changed, and we're already past due. Those items would be entered as a 0 temporarily in the Brightspace grade book, just so that you have a real sense of where you are in this class right now. I did notice, and I had a couple of students affected by this who sent me emails in the last couple of weeks. I don't know why, but very occasionally there'll be something that you complete in CNow that for some reason the grade doesn't come over to Brightspace. And it's not the entire assignment, so it doesn't affect everybody. It's just randomly here and there, someone might be missing a grade. So I'm going through those and checking to make sure you actually didn't submit it. But if you ever notice that you completed an assignment, you can see in CNow that it was completed, you can see your grade. It doesn't say resume as if you haven't submitted it for grading. If you notice that happen, please just send me an email. Eventually, I should catch up with that as I'm checking all the missing grades. But I don't want that to be reflecting poorly on you or making someone unduly concerned because I don't have a grade for this assignment. If you see that happen, let me know. I have not yet seen this, but if you were to see a grade in Brightspace that doesn't match what's in Cengage, and I don't think that would happen, but if it did, again, just bring that to my attention and I will look into it. So that has not happened yet but as probably know, most of you know anyway, this is our first semester in Brightspace. So strange, odd things could happen. Carter, does that answer your question about 6-week grades? Let's see.
Yeah, I just had like 2 things I had to finish.
Okay.
So I was just curious when you submitted the 6-week grades.
Okay, so they're due Monday afternoon, and if they're small little assignments, they probably wouldn't affect your grade. So okay. Most of the grade at this point is based on that exam 1 grade. As far as 6-week grades go, we know statistically that is the single best predictor of your final grade for any course. And so if you look at your 6-week grades, and I strongly encourage you to do that sometime after Monday, please check your 6-week grades. If you see something that does not make you happy, whatever that might be, some people are happy with just passing a class that's really challenging for them. Some people are never happy unless it's an A, a high A. So whatever is acceptable for you, if you look at those grades and you see something that you know you can do better, I encourage you to think about and be honest with yourself about what the effort level has been so far, and think about what can change. Because if you are not happy with that grade, but you continue to do the same thing that you've been doing for the last 6 weeks, it's probably not going to change. Again, it's the best predictor we have of a final grade. The only way you're going to change that is to change something that you are doing. I would also encourage you, if you think it's appropriate, to talk with the instructor for a class where you're not happy with the grade and work with that instructor on what could I do differently. I should say my grades are, this is your grade. I mean, everything's in there. This is your grade. Some classes don't have enough information at this point to really assign a letter grade that has any meaning. So, and I know this happens somewhat in English classes because maybe they haven't had a big project or a big paper yet, and you've only done a draft or 2 or something like that. So some classes, some professors may assign what amounts to a pass fail, credit, no credit kind of grade. So you don't actually see that letter grade. That doesn't mean you won't get a letter grade at the end of the semester. But it's really what that instructor is saying is you're doing what you're supposed to do, but I can't really assign a letter grade to you yet. One other thing about those 6-week grades is they don't become part of your permanent record, so to speak. They don't appear on your transcript once the final grades are submitted in December. I think they're due on December 19th or something like that. So once final grades are submitted, that will replace the 6-week grade on your working transcript. So, okay. Any questions, anything about that? Any concerns? Obviously for this class, if you see your grade and it will match whatever Brightspace says, Banner is going to say. Banner is where you would go to check those grades, in case I wasn't clear on that. Banner is where you check your grades. Some instructors may use the Brightspace gradebook, but it's not fully functional for them. Some may not use that at all. So for this class, the Brightspace gradebook is reliable, but that may not be the case for everybody. So you want to definitely go into Banner to check your grades and figure out what you want to change if you don't like what you see. Then if you do like what you see, good job, keep up the good work, and keep doing what you're doing. So this is the 40% mark for the semester. Okay. Any questions? Anything else you want to talk about? As I said, I just want to do one more thing because I just saw on somebody's screens that reminded me. I said this is our first semester with Brightspace, and I have no idea what happened or what somebody did, but as of today, so since Tuesday, the widget here that showed the assignments appears to be just gone. And this box is showing up, but it's not showing my information, even though at the beginning of the semester, it had I had put in my information. So I don't know what they did to change something in Brightspace. I don't know if it's SUNY, which houses our Brightspace, or if something JCC did, but it's this way in all of my classes. I'm assuming it's the same for others as well. So I'm not updating this instructor profile because it was updated at some point, and if I have to update it, I'll have to think about what I want to write there.
So I guess just one more thing about the 6-week. So if I think it's just 2 things I gotta do, but if I submit those 2 things, will that change the 6-week, or since you already had it sent in?
They aren't finalized. So if it changes your grade in Brightspace,
I'm not sure if it would.
So if it does and you see that it changed it, send me a note to make sure that I check. My intention is to check all of them again because people are still submitting things.
Yeah.
But the little assignments are not likely to change your grade.
Okay.
Not one at a time anyway,
Right,
unless you're right at the margin. So.
Okay. Thank you. I was just curious.
Yeah, my intent is to check them all again, but for for the financial accounting classes, I'm in the middle of grading the first part of their projects, which is more critical to their grade. So I don't know if I'll have time between now and Monday. That's my intent. Okay, anything else? So you should be submitting your chapter 19 problem, chapter 20 pre-quiz, and be looking at the sources for your annual report project. And it's due next Thursday. Yep, October 6th. Yep. Okay, if there aren't any questions on that, does anyone have anything you want to talk about from chapter 19 or anything else? So we're going to get started with chapter 20, which is cost, volume, profit, or CVP analysis. CVP analysis. This is my favorite chapter. And I don't know, sometimes I feel like, as a parent, you're not supposed to shouldn't have a favorite child. I feel like I shouldn't have a favorite chapter in this class, but I do, and this is it. And the reason that this is my favorite chapter is because I think it is so easy for people, even people who are not accountants, even people who don't like accounting and say, I would never do that. Why would anyone do that? I think it's easy for even those non-accounting people to look at what we do in the CVP analysis chapter and recognize how this can be helpful for decision-making in a business, even if you don't think of it as accounting. So I really like that part. You can see we have several learning objectives, and we'll be, of course, going through these one at a time as we work our way through the exercises. We're going to start out with a review of what it means to be, what we mean by cost behavior. We talked about that term, that classification back in chapter 15. So that's going to be really important, critical to the work that we're doing in this chapter. We'll be introducing a new concept called contribution margin. And we'll talk about how to calculate that, and you'll see how that can be useful for us in determining how much of a product we need to sell to break even, excuse me, or to make money, make a certain targeted level of profit. I'm going to tell you right now, when you look at a learning objective 4, we're basically not doing that one, which says use a chart to do this. I am not going to cover the chart with you. It is not in your homework. It is not on the exam, because I'm not a visual kind of person. I'm a numbers kind of person, which is probably why I'm an accountant. But if you find the chart helpful, I would encourage you to use it. It's covered in the book. You'll see it in several pages in learning objective 4, but you are not responsible for this class for drawing a chart or even being able to read one. In learning objective 5, toward the end of the chapter, we'll be talking about a much more realistic scenario of what happens when a company sells more than one product. And I should have already done this before I jumped into the PowerPoint. I'm going to show you one thing that I added today in the chapter 20 reference materials folder. So first, we do have this useful formulas. I didn't just add this today, so you may have already seen this if you were looking ahead. But there are some formulas here that we'll be using today. I'll be introducing and explaining where they come from and how to use them. The part that I added today is specifically about the chapter 20 problem. And I apologize for the way this looks, because for some reason, it doesn't want to take my formatting. So everywhere I have spaces, when I typed it, whoops, it just took the spaces out, except this very first one. So I apologize that it's all crammed together like that. Please just, whoops, and there's a typo. Okay. So this is related to one piece of the chapter 20 problem, and it's a piece that's particularly challenging because it doesn't have us doing the calculation front to back, like chronologically. It gives us the end result and asks us basically to work backward. And for many people, that's a bit more challenging because it's not the way you would normally do it, and it's not the way we do it in class. So I've given you a step-by-step explanation. I don't give you all of the answers, but I do explain how to get to the answer that you need to at least be able to do the rest of that part of the problem. So when you get to the chapter 20 problem, which probably for most of you would be next week, remember that this page is here. And there is also a video right here. This is from spring. And in the video, I also talk about the problem along with the exam 2 extra credit. And remember, I already told you the exam 2 extra credit is on the oh my word, I just drew a blank. It's not direct and it's not, oh, reciprocal services. So that's what the exam 2 extra credit is about. And I talk about that a little bit here in this video. It's a pretty short video. But if you're stuck on either the problem or the extra credit, you may want to watch that video because that's what it's there for. So back to our PowerPoint. So back in chapter 15, I had in the reference materials folder a diagram from a different version of different authors, different textbook, but textbook for managerial accounting that divided up costs or classified costs along 4 dimensions. And then I had a brief, and it was nice and colorful. And then I had a brief color-coded explanation under each of those. I'm not going to go back and show that to you now, but if you want to refresh your memory, it's in the chapter 15 folder in the reference materials in Brightspace. All I need to review with you is one of those cost classifications, which is classifying costs based on their behavior. And by behavior, what I mean is what happens if we make more of the product? What happens to that cost? What happens if we make less of the product? So we call that the level of activity. What happens if the level of activity changes? Does the cost change or does it stay the same? And so costs that stay the same in total, regardless of how much of the product we produce, we would call that a fixed cost. A cost that changes, so if we have a higher level of activity, if we're making more of the product, we would expect that cost to go up in total. We would call that a variable cost. The flip side of that is if we make less of the product, we would also expect that cost to go down. So it's very important for what we're doing in this chapter that we can accurately identify whether a cost is fixed or variable. We need to know what's going to happen to that cost if we make more or if we make less of the product. Hopefully that sounds familiar from chapter 15, and it's definitely going to be important for us in this chapter. So for a variable cost, one that changes if we change the level of production, we need to identify what makes that cost change. Okay. Is it how much we produce? Is it direct labor? Is it direct labor hours, direct labor dollars? Is it, I don't know, I'm drawing a blank on others, but we have to decide, what is the trigger, if you will, that makes that cost go up or go down. The other important concept here is, as you can see in the bottom little purple oval there, is relevant range. So even if we identify that a cost is a fixed cost, that is, we don't expect it to change as we vary our level of activity, as we vary our production, we know that at some point that's probably not going to be true. So let me give you an example. One example of a fixed cost would be the insurance that we pay on the building, or the production facility, the factory. So the insurance on our facility is based on the value of that facility, the value of the building. And we expect that that insurance is going to remain the same, or at least be predictable. We know how much it's going to be, regardless of how much production, including if we stop production, we'll still have the building, and it's still at least temporarily going to have the same value, and therefore the insurance is going to be the same on that building. It's not based on how much we produce, it's based on the underlying value of that building. If we stop producing, though, eventually the value of that building is going to go down because it's not being used, and it's probably not being kept up, and it's going to deteriorate. And if we start producing more and more and more, we're probably going to have to build a bigger factory or bring in some more machinery or something like that. And that could increase the value of the building. And so our insurance would consequently go up. So when we talk about a cost being fixed, we mean fixed within our expected range of activity. So let's say we make bicycles and we expect to make 1,000, I don't know, 1,000 bicycles this year. We probably will not end up making exactly 1,000 bicycles. We might make 950, we might make 1,100, but there's some range around that expected value of 1,000. There's some range that we think is reasonable or realistic. And within that range, we expect the fixed cost to remain constant. In addition to that, our variable costs, although we expect them to go up and down, we do expect the variable cost per unit to remain the same. So those bicycles we're making, each one of those bicycles is going to get 2 tires. And we expect within our relevant range, the numbers I just threw out there were 950 to 1,100 bicycles is how many we think we're going to make, somewhere in that range. We expect to make 1,000, but we might make 950, we might make 1,100. Within that range, we expect the cost of the tires for our bicycle to remain the same per unit. So we make more bicycles, obviously the cost of tires in total goes up. That's what makes it a variable cost. Per unit, we expect it to be the same. If we were to cut our activity down, so we're only making 200 bicycles, it might be that the cost per tire goes up because we might get some kind of a bulk discount, right? Or maybe the shipping becomes more expensive if we only order 400 tires instead of 2,000. So that's what we mean by relevant range. And the more narrowly we can define that, the more confidence we will have that our fixed costs are going to remain the same and that our variable costs per unit will remain the same. Let's go to take a look at our first exercise. Now, there are a couple exercises in this chapter that are what amount to multiple choice questions, and they don't even have a whole lot of options. So I don't necessarily find going through these one at a time together very useful, because you can yourself use the check my work button and see if your answer is wrong. I'm going to go through a couple of these just to make sure that you understand what it is we're after. And I also need to talk about the concept of mixed cost, because that's going to lead us into not our next exercise, but one that we will get to today. So I said that it was important, it's critical, actually, to the success of what we're doing in this chapter, the CVP analysis. It is critical that we know about the cost, the behavior of our costs. We need to know, are they fixed or are they variable? Well, some costs actually have a portion that's fixed and a portion that's variable, and we call that, not surprisingly, a mixed cost. So in exercise 4, we are going to talk about, well, when we have a mixed cost, what do we do about that? Because our formulas that we're going to be using in this chapter require that we have our fixed costs and our variable costs separated. So when we do have a mixed cost, we have to use some mathematical approach to separating them. And I'll talk about a couple different ways we can do that, but you're only responsible for being able to do one of them, because most of them are beyond the scope of this class. But we'll talk about the simplest way of separating a mixed cost into its fixed and variable components, and we'll see that in exercise 4 later today. So let's start with exercise 1, though. As I said, we're going to do a couple of these, and then I'm going to ask you to complete this on your own. Following is a list of various costs incurred in producing replacement automobile parts. With respect to the production and sale of these auto parts, classify each cost as either variable, fixed, or mixed. So the first one is oil used in manufacturing equipment. So it stands to reason, I think, that if we're using it in the manufacturing equipment, and we make more of the replacement auto parts, that we probably have to add more oil to the equipment to keep it running properly. So for that reason, I would call this a variable cost. Now, I would say that if you have inside information, if you work for this company and you know, nope, they add the oil every month or every 3 months or whatever, regardless of how much the equipment is used, then that would make it a fixed cost. But I'm making an assumption that it's variable. How about the property tax in number 3? The property taxes, we're told, are $165,000 per year. It doesn't say anything about how much we're making. So property taxes is an example of a fixed cost. It remains the same regardless of how much we're producing, or even if we shut down and stop producing. And we'll talk about in this chapter, why would you want to shut down? Why would you ever do that? And for those of you who will be taking economics, microeconomics specifically, is anyone taking microeconomics this semester? Just Nanji? Any? What?
Jen.
Oh, okay, Jenna. So, so in microeconomics, that's also something you'll talk about. The shutdown decision for production. A salary, of course, would be a fixed cost, because that's what salary means, that manager gets paid the same regardless of how much or how little production is happening in the factory. That's what salary is. How about number 9, rent on warehouse? So we're told that it's $10,000 a month. Well, that sounds like a fixed cost, but then there's an additional $25 per square foot of storage used. And so that makes it a mixed cost. The fact that there's a fixed component, but then there's a variable piece as well. So that becomes a mixed cost for number 9. Okay, so we're going to stop there. As I said, you can finish that one up on your own. Obviously, if you do have questions on any of them, I would be happy to answer those questions, but I don't see a lot of value in us going through them one at a time, unless there are issues, unless there are questions. Oops. But let's move on to number 2. So in that slide that we ended just a minute ago, I also talked about activity bases, or determining what makes those costs go up and go down. So the activity base is what we believe is a valid way of predicting costs. And ideally, it's the actual cause of those costs going up and down. But at minimum, it's a way of recognizing when those costs go up and down. And so for exercise 2, it says, for a major university, select the activity base most appropriate for each cost listed below. An activity base may be used more than once or not used at all. So again, we won't do all of these together. I'll ask you to finish these up on your own. But for the financial aid office salaries, it seems that a way of recognizing those costs would be the number of financial aid applications. In other words, the more financial aid applications the school has to process, the more people they need working in that office. Does that make sense? So that's a reasonable way of dividing up those costs, or recognizing why the costs go up and down. How about housing personnel wages? Well, not everyone, as I'm sure you know, not everyone who attends the school lives on campus. And so basing it on the number of students wouldn't make sense, because we don't need housing personnel for students who live off campus. Same thing for number of enrolled students and alumni. Well, why would the alumni have anything to do with housing personnel? So really what we're looking for there is the number of students living on campus is a reasonable cost driver or activity base. The more students we have on campus, the higher those housing personnel wages would need to be to service those students. So again, I'm going to ask you to finish those up on your own, but if you do have any questions, I would be happy to help with that. Okay. And let's move on to our next exercise. And this one we will complete together. This exercise deals with relevant range and fixed and variable costs, and we've already mentioned those. Child Play Inc. manufactures electronic toys within a relevant range of 20 to 150,000 toys per year. Now, from what I already said at the, just a couple minutes ago, in my mind, that range is far too wide, far too broad. I can't fathom that in any given year that the company might make 20 or 150,000 toys. That's not specific enough. And we, as I said, the wider that range is, the less confidence we have that our understanding of the nature of the cost or the behavior of those costs is valid. It's really not reasonable to think that a cost that's $1,000 when we make 20,000 toys is the same when we make 150,000 toys. Even those fixed costs are probably not going to be fixed over that wide a range, but it's what they gave us. I'm suggesting in reality, you'd want that range to be much narrower. Within this range, the following partially completed manufacturing cost schedule has been prepared. And so they've chosen 3 different breakpoints, 3 different production levels that are within that relevant range. Typically, in my mind, when I see 3 like this is how I think of it. 80,000 is our expected value, or this is what we think is most likely to happen. We expect to make about 80,000. 40,000 would be the worst case, and 120,000 would be the best case scenario. So we'll talk about this in an upcoming chapter, but let me just pose this question. If you are this company, Child Play Inc., what would make you decide to produce only 40,000 or to produce 120,000 of whatever these items are that we're making, toys? If we expect to produce 80,000, what would make us produce only 40? Then what would make us, on the other hand, produce 50% more and 120,000? What do you think would make a company change like that? Demand. So I would say demand should be, and again, we'll talk about this in an upcoming chapter, but from a business standpoint, demand should be the #1 predictor. The #1 determinant of how much we make should be how much can we sell. And we call that pull-through production. In other words, we make it because somebody wants to buy it. Now, in the environment in which we are operating right now, I would suggest that if the company wants to make or plans to make 80,000, a reason they might make only 40,000 could be related to all the supply chain issues we're seeing. That maybe they can't get the raw materials or they can't find the labor that they need to produce. But in normal business circumstances, my suggestion is that your production should be based almost exclusively on how much can you sell. And that's how much you should be making. So let's go ahead with the first column here. When they plan to produce 40,000 toys, their budget indicates that they would spend $720,000 on variable costs and $600,000 on fixed costs. So let's go ahead and complete that first column to find the cost per unit. So if we know the total cost, we simply need to divide by the number of units to find the cost per unit. So the total variable cost of 720,000 divided by 40,000 units is $18 per unit for the variable cost. And the 600,000 in fixed costs divided by 40,000 units is $15 per unit. So our total cost per unit would be $33 if we make 40,000 units. Everyone agree with that? Okay. Now here's where we need to stop and think. We said that fixed costs, the definition of a fixed cost is one that remains fixed in total, regardless of our level of production. So if we're told that the fixed costs are 600,000 at 40,000 units produced, it should also be 600,000 if we produce 80,000, 600,000 if we produce 120,000. So the fixed costs remain constant, remain fixed in total. But the variable costs I told you remain constant per unit within our relevant operating range. And so I'm carrying that variable cost of $18 per unit across, even though I said this is a pretty wide range. We're going with what the exercise tells us, which is this is their relevant operating range. Even though I think that might be a little bit suspect. Now we can fill in the rest of the blanks. So the variable cost per unit is $18. If we make 80,000 units, then our total variable cost should be $1,440,000. Everyone feel okay to finish up the rest of this? I'm going to let you try that on your own. I'm going to do mine on the screen as well. And you can use the check my work button, of course. Excuse me. Anyone have any questions about that? So the purpose of that exercise is just for us to be thinking about how varying levels of production would affect our fixed costs. And the answer to that is within our relevant operating range, it shouldn't affect them in total. And how it would affect our variable costs. And again, within that same relevant operating range, the variable cost per unit should remain the same. And what you can see happening then is that the fixed cost per unit, the more we produce, the lower that goes per unit. And that has an immediate impact on our total cost per unit. So to be able to use CVP or cost volume profit analysis, as we're going to do shortly, we need to be able to correctly identify the cost behavior for each one of our costs and classify it as fixed or variable. And if we recognize that it is a mixed cost, we need to have a way of separating the fixed from the variable component of that total cost. And that's what we're going to do next. So I'm going to ask you to think back to when you may have taken geometry. I think it's geometry. I don't know this. And is it geometry where you learn about like formulas for a line, equations for a line, and that it is, right? Am I?
like are you saying like lines on the graph?
Yeah,
Might be more than trigonometry.
okay. But whatever it is, this is a math that I suspect you've taken. And if not, it's okay, because I'm going to talk about what you need to know. But I do like you to recognize what exactly it is we are doing here. So does anyone remember when you may have taken geometry or trig? It really doesn't get to the level of trig, but does anyone remember, does this sound familiar, the concept of the slope intercept form of the line, of a line? Does that sound familiar to everybody? Does anyone remember what the generic formula is for the slope intercept form? Whoops. Anyone remember what the generic formula is? I'll get you started. Y equals, that's it. Y equals mx plus b. Okay, so that is the slope intercept form of a line. And that is exactly what we are using in this exercise, in the high-low method. I'm going to come back to that in a minute. So I said that there are a number of different ways that a company might use, a number of different techniques that a company might use when they recognize, hey, we have a mixed cost here, and we need to be able to separate the fixed from the variable. Some of them are very, I'm going to call them high tech. Has anyone taken statistics, Math 1540? Okay, so if you've taken statistics, you've already done one of these. And that is the tool of linear regression. In this case, because we have two variables, it's simple linear regression. And that is a very useful tool for separating mixed costs into their fixed and variable components. In a simple linear regression, we take a whole bunch of XY coordinate pairs and we plug them into the software and we say, okay, find us the best fit line, the one that minimizes the error term. That is, drop a straight line through these data points and find the best line so that the dots, all of those XY coordinate pairs, are as close as possible to the line. That's what linear regression does mathematically, finds the best fit line. And that is one very legitimate, very reliable way of separating fixed and variable costs out of a mixed cost, as long as there is a straight line or linear relationship. And so in order to do that, and in order to use the slope intercept form, we first need to make sure that there is at least roughly a linear or straight line relationship between the two variables. And the way we would do that is by constructing a scatter plot. Does everyone know what a scatter plot is? You draw your XY coordinates and then you just put all the dots on there, right? That's called a scatter plot. I probably can show you an example of one in the PowerPoint if you don't know what I mean, or you can just Google it and you'll see all sorts of different types of scatter plots. So the first step really would be to do a scatter plot with the data we have and make sure that they do at least appear to be in a straight line. Roughly straight line, it's not going to be perfect. That would be the first step, whether you want to use linear regression or what we're going to do here, which is the high-low method. Another way of separating fixed and variable costs out of a mixed cost is what's called the engineering method. And we actually do kind of a time in motion study to see what does make those costs go up. So we do a deep analysis of all of the available data to determine what is the relationship between these two variables, if there is one at all. Both of those, simple linear regression, certainly multiple linear regression, even scatter plots, we're not going to be doing in this class, but I want you to keep that in mind, that before we use this method, the high-low method, we really need to make sure it's appropriate. And what that means is, if we're going to use right here, the formula y equals mx plus b, that is a formula for a straight line. So if our data are not in a straight line, or at least something that approximates a straight line, we shouldn't be using this approach. So there are other approaches. The other approaches might be more valid, might give us a better result, more predictive value. But because of the level of math that we are using in this class, that we are not using those other approaches. The only one you are responsible for knowing how to use is this high-low method, which, as I already said, really is taking the slope-intercept form of the line and applying it. So in this exercise, we are given, let me read the beginning part. Ziegler Incorporated has decided to use the high-low method to estimate the total cost and the fixed and variable cost components of the total cost. The data for various levels of production are as follows. So we have units produced 80, 92, and 120, and total costs ranging from 25 up to 32 million. So to do the scatter plot, I'm just going to do this very, I'm not going to try to do this at all officially. To do the scatter plot, we would do like this. I'm just going to use the star to represent the points on my graph. And on the x-axis, those of you who have taken statistics, this should sound familiar already. On the x-axis, we're going to put the value that we're using to predict, known as the independent variable. And so in this exercise, we're trying to see if we can predict total cost based on units produced. And so we would put the x-axis would be units produced, because that's our independent variable. And the y-axis would be our dependent variable, which is total cost. And we are trying to find a formula that will help us predict the total cost if we know how many units were produced. Whoops, so I was going to put the stamp. So again, I'm not doing this in any kind of a official way. I'm not trying to make this look exact or pretty. But we would go out here on the x-axis if I had labels and go to about 80,000 units and then go up to $25 million. And we would drop our dot there. And then we would go out to 92,000 units and go up to 27,000, maybe right there. And finally, we'd go out to 120 units, 120,000 units, excuse me, and then go up to the 32 million. And so that's roughly how we would construct our scatter plot. And for the slope-intercept form of a line, we would take those three dots and we would see, does it look like they're roughly in a straight line? And they are. And then I would continue that line over to the y-axis, and X marks the spot. I'm going to mark where it crosses the y-axis. That is the y-intercept. So with the slope-intercept form of the line, the slope is how steeply tilted this line is, and the intercept is this point right here, where x equals 0. Is this sounding familiar to people? Even if it's not fresh in your mind, hopefully it sounds familiar. Okay, so again, we look at the data that we have and we see, are they at least roughly linearly related? Do they form a straight line or pretty close to it? And the answer here is clearly yes, because I made it that way when I drew my graph. If you really wanted to check that, you could use Excel and use the graphing function in Excel or any other program to check that for you. Now with the slope intercept form of a line, I just want to put some notes here where M is the slope and B is the y-intercept. For this problem, I already explained, I already labeled the graph telling you that y is total cost. That's what we're trying to predict. And x is the number of units produced. So the y-intercept would be where x equals 0, where what our total cost would be if we didn't produce anything. Okay, the y-intercept then is, whoops, our fixed cost. Whoops, fixed cost. Can't type today, apparently. Fixed cost. The y-intercept is our fixed cost. That is, what would our total cost be if we didn't produce anything? And then from there, the slope of that line, M, is our variable cost per unit. The slope of the line is our variable cost per unit. For every unit we add to our production, how much does our total cost go up? That is the slope. So many of you said you remember at least the concept of the slope intercept form of a line. Does anyone remember how to find slope? What the formula for slope would be? Rise over run is one way. Change in y, so I can't make a delta on here, but change in y divided by change in x is another way of, okay, y2 minus y1 over x2 minus x1. It's how much does the y change for every unit of change in x. That's what it is. Okay. That is exactly what we're doing in this calculation. So, as I said, you don't really have to know what slope intercept form is. You don't really have to know how to calculate slope to do this exercise, because I'm going to show you just the calculation itself. But I think it's very useful to recognize what it is we're actually doing here, which is calculating what would our cost be even if we didn't produce, and then how much does it change with each additional unit of production that we add. So let's go ahead with our calculations then. This is called the high-low method. So the next thing we need to do, once we've established there is something like a straight line relationship, the next thing we need to do is identify which of these is the high point, excuse me, and which is the low point. On our graph, that's very easy to see, which is the high point and which is, so here's our high point, here's our low point. The reason that the high-low method is not as reliable as using a simple linear regression is that any points other than the high point and the low point, we're just going to ignore them. And so that's another reason that doing a scatter plot first is kind of important, because your high point could be an outlier. So those of you who've taken stats, I assume you know what an outlier is. It's something that doesn't fit the regular pattern of the data. And so if your high point is an outlier, let's say our high point was up here, that would make our straight line not a very good fit. If your low point was an outlier, again, it would make our straight line between the high and the low point not a very good fit for the rest of the data. Where a simple linear regression takes all of the data points into account. But it's just beyond what we're going to do in this class. So we've identified our high point and our low point, and luckily, based on the way I've drawn them here, we can assume that it's a good fit. For the purpose of this class, if you are given a set of data like this, you're not required to do the scatter plot. You're not required to determine if there is a straight line relationship. Instead, you are you can take it for granted that if they're asking you to use the high-low method, that it is appropriate. But if this was a real world situation, one, you probably wouldn't want to use the high-low method anyway, but if you were going to use it, you'd first need to verify that it was a valid approach. Okay, so now we're going to go ahead and calculate the slope, but does anyone have any questions before we do that? Okay, so we already know which one is the Y. That's going to be our total cost. I'm just going to label that column so we don't forget. And we know that the units produced is the X. We're using the units produced to predict total cost. X, units produced, is our independent variable. Y, total cost, is our dependent variable. Our total cost depends on how many units we produce. So it does not matter which of the 2 points we call point 1 and which one we call point 2, as long as we go in the same direction, as long as we keep, if we say that 80,000 units produced is 0.1, we also have to say that 25,100,000 is the 0.1 for the Y. So as Nanji said, the formula for slope is rise over run. So, or change in Y over change in X. So let's do our change in Y. I'm going to use the 120,000 point as the first point, just so I don't have to deal with so many negatives. You get the same answer as long as you use the same 0.1 for each of them. Whoops. And so there's our formula. So now it's just a matter of calculating. Our units changed by 40,000. We went from 80 to 120,000 units produced. How much did our total expenses change? $7,020,000. So our expenses changed, our total cost changed by $7,020,000 when we increased our production by 40,000. And so that gives us a slope of 175, that is $175.50 per unit. And that's your answer to the first part of letter A, $175.50 per unit. You could easily have calculated that without understanding that it's the slope intercept form of the line, that you're calculating slope, but I really like keeping it in the context of this line because it makes it easier, I think, to understand what exactly that number means. If we make one more unit, our total cost would increase by $175.50. We can now plug that into our original formula, Y, and I can use total cost. We already know that total cost is our Y. We have our slope, $175.50. We know that our X is the number of units produced. Oops. So I was taking the original slope intercept form, Y equals mx plus b, plugging in what we know. Y is our total cost. M is 175.50 per unit. X is the number of units we produce, and B is our fixed cost. So that's our formula as of right now. We can take either one of these 2 points, the 80,000 or the 120,000, and plug it in for total cost in units, and then solve to find our fixed cost. You could do it either way. Doesn't matter, you'll get the same answer. And so, because I am fundamentally efficient, I'm going to use the smaller numbers. That will make it, whoops. So I'm just plugging in here. Oh, sorry, I plugged that in backward. Try this again. Our total cost, I'm going to use the smaller numbers, 25,100,000. And our number of units at that total cost was 80,000. There we go. And now I'm just going to solve for our fixed costs. And I got 11,060,000. Now I can finalize my formula. Our total cost, this is our prediction of total cost, $175.50 times the number of units we produce plus our fixed cost of 11,060,000. Whoops. $60,000. And for the last step then, our total cost, if we make 115,000 units, now let me point out that 115,000 units is within our relevant operating range. It is between these 2 points on our line. It is not appropriate to use this equation to predict for something that's outside the range of our data. Our data range from 80 to 120,000 units produced. We should not use this equation to predict our total cost if our units are less than 80,000 or more than 120,000, because we don't know what happens to this line outside of that. That's called extrapolating, extra, going outside. We can't extrapolate outside our data set. It's perfectly fine to interpolate, which is to go between 2 existing points. It's not acceptable because we don't know if it's correct. We don't have any data to support that the line continues in a straight line above and below those outer points. But it is okay to use it for the 115,000 because that's within our relevant operating range. And so when I plug 115,000 in for the number of units, I found a total cost of 31,242,500. I always like to check for reasonableness. That is between the 92 and 120, closer to the 120,000 units. And it's between the 27 and $32 million, closer to the 32 million, which is what I would have expected. So that seems like a reasonable result to me. And so that is the high-low method. Really, it is the slope-intercept form of a line, finding the slope, then finding the y-intercept, which is the fixed cost. The slope is the variable cost per unit. But if you don't like thinking of it like that, then you're just following the same math without really the basis of understanding why it makes sense, why it works. I would always prefer that you understand the why, not just the how part. Everybody feel comfortable with that? Any questions about how to use that? Okay, let's keep going. My session has ended. Okay, that's just bizarre. It just jumped me into financial accounting. Okay, give me a moment. I'm gonna pause the recording for a second. Okay, after a little technical issue, we are back on track. I have my chapter 20 exercises open again. And I moved on to our next exercise, which is related to contribution margin. So I need to talk about contribution margin first. In the reference materials, let's see what I can find here. So in the reference materials folder for chapter 20 in Brightspace, you see a page that looks like this. And for some reason, this page allowed me to have spacing as I would like, unlike the other page that I've added to this folder. So what I want you to notice first is this formula right here. If you think about our financial accounting, and I know this is managerial accounting, but all of you have taken financial accounting. And in financial accounting, when starting in chapter 1, when we looked at a simple income statement, it was revenues, which are sales, minus expenses, which are costs, equals income. And in chapter 5 in financial accounting, we took that one step further and we introduced what's called the multi-step income statement. And in the multi-step income statement, it looked like this. So this is the multi-step income statement from chapter 5. Sales minus cost of goods sold, sold equals gross margin, or what this textbook, and I know none of you who are here in the on-campus class, none of you used this same textbook for financial, but some of the online students who may be watching this video did. So this book refers to it as gross profit, but I prefer the term gross margin. And that is the closest analogy to what we're doing in this chapter, so it just makes sense. Minus our operating expenses, which are selling, general, and administrative expenses, equals our operating income. Okay, so this is the approach that we use in financial accounting. It's what's required for GAAP. GAAP requires that we report our expenses as cost of goods sold and operating expenses. For decision-making purposes, for internal reporting and decision-making in managerial accounting, we're taking those same concepts of revenues and costs, but instead of dividing them based on whether they're product costs, so cost of goods sold is a product cost, and operating expenses are period costs. And those terms we introduced back in chapter 15 on that same cost classification flow chart that I was talking about toward the beginning of class. So in this chapter, rather than taking our costs and expenses and dividing them based on product versus period, instead, we divide them based on whether they are fixed or variable, based on their cost behavior. So in this example, sales, whatever we have for sales here, we have for sales here. Whatever we have for operating income, we have for operating income here. The top and the bottom don't change. That means the total expenses or the total costs also do not change, but we are simply dividing them up a little differently. We are dividing them based on whether they are variable or fixed. And so what we've been talking about so far in this chapter, you can see why it's important, especially if we have a mixed cost, that we can separate it reliably into its fixed and variable components and be accurate, be correct about that. We also have to, for all the non-mixed costs, we have to know for sure or be pretty confident that we know whether it's a fixed cost or a variable cost. Because if we put them in the wrong category, the whole predictive model that we're trying to use here with cost volume profit analysis will be wrong. if we are wrong about whether a cost is fixed or variable, it affects our ultimate calculations. Okay. Any questions so far? So all we're doing with the contribution margin is, rather than dividing our costs based on product or period, we're dividing them up, separating them based on fixed versus variable. The contribution margin then is the new concept here. And you can see contribution margin rather than gross margin. Contribution margin is what's left of our selling, of our sales, of our revenues, what's left of our sales after we cover the variable cost. What is left to contribute toward our fixed costs and hopefully turn a profit. So if anyone is interested in how we do it, I would be glad to show you. But what I would like to, what I'd like to start by saying is, if we take this formula, sales minus variable cost equals contribution margin, minus fixed cost equals operating income. I'm just going to write that horizontally rather than vertically. So sales minus variable cost minus fixed costs equals operating income. Okay, so that's the same formula. Everyone agree with that? Sales minus fixed variable cost minus fixed cost equals operating income. If we recognize that we can find our sales by taking the selling price per unit and multiplying by units, if we recognize that our variable cost is in total is our variable cost per unit times our units, and so really what I've done there is add a little bit more detail. Sales is our selling price times units. Variable cost is our variable cost per unit, which we just recognized is fixed is constant per unit, I should say, times units. We can then factor out the units. We can solve for the number of units. If anyone wants me to keep going with that, I would be happy to do so. But I just wanted to show you that it's ultimately this formula that I solved for the number of units to get this formula. This formula, this formula right here is what we are going to be using for CVP analysis. That is it. Okay. That is the formula. And it's in the reference materials folder for chapter 20. And I would encourage you to take a note of that. The other thing I would just point out is the book, in my opinion, the book overly complicates this. They seem to imply that there are actually two different formulas, and they're not. There is just one formula. It's right there in the red box. We can find the number of units by taking the fixed cost, adding to it the profit that we're targeting, the amount of money we want to make, and then dividing that by the contribution margin per unit. And I have another formula here. The contribution margin per unit is selling price per unit minus the variable cost per unit. It's how much we have left of the selling price after we cover the variable cost. Direct materials and direct labor are the biggest variable cost of our product. And we already know that from earlier chapters. So as I said, I would encourage you to make note of that formula. We're going to be using that over and over again in our coming exercises. Okay, any questions about that? You don't really, I'm not going to ask you to derive that formula. I'm just going to ask you to use it. But I'd like you to know where it came from. is it doing this? Oh my word. Okay, so I got back in. I apologize for the choppiness in the video, I'm sure, because it keeps tossing me out of Cengage for some reason. Haven't had that happen before. I don't know why. So let's go to exercise 5 as we get close to the end of our class for today. We now have seen that the calculation for how do we find the number of units, and we'll be using that throughout the rest of the chapter. But we also introduced the concept of contribution margin, which is sales minus variable cost. And so in this exercise, we're asked to calculate the contribution margin ratio. Now, I personally don't find that the most intuitive way to calculate, to answer some of these questions, but I will use what I think is more intuitive and the contribution margin ratio approach, because that's the way it is presented in the book. And so you may find it beneficial to use one or the other. You're welcome, because you'll get the same answer either way. You are welcome to use whichever approach of the two, whichever approach seems more comfortable for you. So let's start with part A. So first we want to find our contribution margin in dollars. And with what we were just looking at on that page of reference materials, chapter 20 folder in Brightspace, the contribution margin is our sales minus our variable cost. Whoops. And so this is our contribution margin in dollars. This is how much the company has. Whoops. Sorry, I put my comma in the wrong place. Let me go fix my comma. Oh, whoops. Sorry. There we go. Oh, I must have hit insert. That's what happened. Okay. So that is our contribution margin in dollars. This company has generated $46,289,000 worth of revenues after it paid for the variable costs, and that is available then to apply toward the fixed costs. For this company, the fixed costs were given as $25 million according to their budget. And so that means they have about $21 million left for profit after they cover the fixed costs. What we're asked for here, though, is the contribution margin ratio. And the formula for that, so this contribution margin ratio, and I will consistently use that abbreviation CM for contribution margin. So the contribution margin ratio is the contribution margin divided by sales. So contribution margin as a percent of sales. So we're taking that 46,289,000 and dividing by the 112,900,000 in sales. And so the answer to part A for this exercise is 41%. Excuse me. And one way of interpreting that or understanding that, what does that mean? They get 41 cents for every dollar in sales. They generate 41 cents to apply toward their fixed costs. So remember, the variable costs are only incurred when they're making and selling the product. So if for every unit that they make and sell, they first have to cover the variable cost. And then they have to, whatever's left is available as contribution margin to apply toward their fixed costs. And once they cover all the fixed costs, that 41 cent becomes profit or operating income. Letter B. If the contribution margin ratio for Martinez Company is 40%, they tell us the sales and the fixed cost. They want to know what was the operating income. So I think to make this easier for us, I'm going to write out the formula, which I did not have the formula on the screen. So the contribution margin ratio, I'm going to write out the whole thing, is the contribution margin, which is sales minus variable cost. And then we divide by sales. So having the formula written out like that is going to make it easier for us to see how we can plug into this what was given in the exercise. So we're told the contribution margin ratio is 40%. We're told their sales are 34,800. We don't know their variable cost. And so I'm leaving that as a variable and then dividing by sales. So using the same formula that we used in letter A, I'm plugging in what we were told or what we know from this exercise. Now it becomes a simple math problem to find our variable cost. So I'm going to first multiply each side by 34,800,000. And so on the left-hand side of the equation, I now have 13,920,000. So how do we interpret that? If their contribution margin ratio is 40% and their sales were 34,800,000, their contribution margin in dollars must have been 13,920,000. Keep going with solving here. And because I'm aware that we have just a couple minutes left in class, I'm just going to go ahead. I'm going to add variable cost to both sides and subtract 13,920,000 from each side to find our variable cost. So our variable cost, 20,880,000. Oops. Okay. So from this, we know their sales, we know their variable cost, we know their fixed cost, and we can directly calculate the operating income, taking the sales, 34,800,000, subtracting the variable cost of 13,920,000, and then subtracting the fixed cost of 1.5 million. And we get, whoops, $19,380,000 would be their operating income. I think I just had a math error somewhere. Somewhere I have a math there. Oh, I didn't subtract what I said I was subtracting. So so we take the sales, we subtract the variable costs of 20,880,000, and then the fixed cost of 1.5 million. That's better. So what I punched into my calculator, I don't think was what I was saying. We take our sales, we subtract our variable costs here, our fixed cost here, and that gives us our operating income. So we are 1 minute remaining in class. Does anyone have any questions? Anything you want to ask about before we call it a day? So for those of you who are working ahead, which you certainly can do, remember if you start working on the chapter 20 problem that you may, if you run into trouble with the sales mix, we haven't covered that in class yet, make sure you check that page in the chapter 20 folder. Okay, thank you for being here, and I hope to see you all on Tuesday.